Hi, and welcome back to another episode of The Mortgage Musketeer, where today I'm going to be talking about interest rates. I've been getting a lot of questions about what happened to interest rates. Okay, so in order to actually give this a really good frame of reference, what we need to do is think about where were rates a couple years ago, what happened during the pandemic and why, and where are we at now? So I think the biggest thing that shocked people is recently they've heard that interest rates went up super fast, but they don't really comprehend how much they went up or what's going on, and they don't really have a good frame of reference because we tend to have a very short memory when it comes to interest rates, to include your own. Half the people, if you ask them what their interest rate was a year after they closed their home, most of them don't even know. But everybody knows, oh, I want a low interest rate, or what are your interest rates? Well, historically, rates were, over a long period of time, averaged somewhere around over 6%. So we have been not only historically low, but like ridiculously low. And the reason for that is because of the pandemic. And the Fed had actually stepped in and were buying billions and billions of dollars worth of mortgage-backed securities, right? So now they're like the owners of trillions of dollars worth of mortgage-backed securities. And that kept interest rates very, very low. And the rationale was if you can keep the interest rates low, it will help build the economy. So everybody remembers this 2007, 2008, the mortgage crisis, and everybody's all worried about it. No, we're gonna have another mortgage crisis. But that tanked the economy at the time. And that was because of very poor lending practices. But since then, there have been so many laws put in place that actually protect the lending industry and ensure that we have something called an ability to repay. And that makes the loans that we have today in our system far more strong than they ever were before. So that has a good basis and a foundation for the lending industry. Now, if the Fed steps in and they buy all these mortgage-backed securities, that's what drives down the rate. Not necessarily the Fed's rate, but the actual mortgage interest rates are based upon mortgage-backed securities. So what happened was they were supposed to ease off of that and rates would rise gradually. Well, inflation has really ticked up and the government had to do something about it. And one of the levers that they had to pull was to actually ease back a little faster on how many mortgage-backed securities they're buying. And what that did is it made interest rates rise rather sharply and caught quite a few of us off guard. Luckily, I lock all my rates, but I know I've heard a lot of people who were floating their interest rate and hadn't locked it in, and they lost their rate. So it can be pretty painful when the market goes up. And we've been in a couple of years of really good rates, so people were taken by surprise. Now, I've talked about this, but let's actually get a visual of what that really looks like. Let's take a look at the computer. Okay, so what I have here is the FHA and the 30-year conforming. So the 30-year conforming is right here. This is kind of where rates have been, and these are based off of rate locks. Okay, and you see since November, over the past 3 months, rates have increased dramatically. So this is based off of the average rate locks in the United States. Okay, so if you want to know where rates are, this is about where the conforming conventional rate is. Now this is your average FHA. Now this graph here represents about 35% of the locks that are out there. So it just gives you really kind of a decent sense of what's going on. You may find rates a little lower, a little higher, depending on where you go. But this is where rates are today. All right, and if you throw in jumbo and VA and USDA, you can kind of see this is how rates work. And you'll see if we take off a lot of this, and I just want to leave these two on here to give you an idea. So this is kind of where we're at. We're rolling along into January, and all of a sudden they stopped buying the mortgage-backed securities, and oh my goodness, rates jumped up quite a bit. So you can see, where they were, anywhere from half a point to 3/4 of a point, they really jumped up. Okay, now to give this a little bit more of a frame of reference, let's look over the past year. All right, so you can kind of see back in February where they were. This is February 21. All right, and then they were holding pretty steady, and all of a sudden they jumped up. All right, and this is when they stopped their buying their mortgage-backed securities. Let's look at 2 years. All right, so you see where we were before the pandemic, right? So this is back in March of 20. This is that whipsaw, the craziness that, they didn't really know what was going on with the pandemic, and everybody was worried, and the market was all scared and craziness. And this is where, because of the volatility, This is where the government started buying the mortgage-backed securities, driving the rates down until they reached the bottom somewhere around January of 21. And then it spiked up again, all right? And then it evened out. And now we're spiking again. So this gives you a sense of where we're at. Now, keep in mind, this is where rates were. As a matter of fact, if we went back a little farther, we would see that rates may have been actually a little higher. Rates were actually driving into the 4 or 5% range. We were, there was rumors at one point in time that we were going to be headed into, the 5 and 6% range. Now, we may or may not head back there again, but you get the idea that really it's nothing new. We're just actually heading kind of back to normal, if you will. So hopefully this gets you a really good sense of what happened, and we can throw in jumbo and VA and USDA and give you a sense of kind of where rates are. And VA tends to be slightly lower nationally. Okay, so hopefully this gives you a good sense of what's happening in the market and where we were, what we look like when we were down low, and where we're at now. I did a video on the cost of waiting not too long ago, and I told people you need to actually get out there and buy before interest rates go up. It'd be worth taking a look at that video so you can see buying power and how that changes. Hope this was helpful. If you have any questions, leave comments below. Love to help you out. Curious what you think. And until next time, it's all for one and one for all.